The market is currently active, and the Nebius Group NV, ticker symbol NBIS, is trading at $115.04, showing a dynamic plus 4.63% gain on the day. That kind of intraday swing, especially after a substantial rally, immediately tells you this isn't a stock for the faint of heart, or for someone exclusively looking for the relative predictability of a Schwab Intelligent portfolio or the steady hand of managed Fidelity mutual funds. The stock's recent movement has been a series of violent surges and pullbacks, and this latest jump, moving from a day low of $99.65 to this current level of $115.04, is far more than just typical daily noise. It's a direct reaction to some very specific new information that completely changes the narrative around their recent earnings, injecting a sudden massive dose of future cash flow confidence into a company that just reported a mixed quarterly bag. The prevailing market expectation coming into this morning was that Nebius, an AI infrastructure and cloud services provider, would face significant pressure due to the substantial capital expenditure required to keep pace in the GPU cluster wars. The common belief among many retail and even some institutional online investing circles was that despite the clear growth in the AI sector, Nebius was burning through cash too quickly, evident in their negative operating income and the recent run-up making the valuation look stretched with a PE ratio around 119. They were seen as a high-potential yet high-risk play, a stock to maybe allocate a small, speculative portion of your individual brokerage account to, perhaps through a platform like Robinhood stock trading for its ease of use, but certainly not a core holding. The expectation was a modest, maybe slightly down day following their Q3 results, which reported a net loss from continuing operations of nearly $120 million. The reality, however, delivered this morning, is a $3 billion five-year agreement with Meta to provide AI infrastructure. That news drop, coinciding almost perfectly with their Q3 report, acts like a multi-billion-dollar shock absorber for the market's fear. Suddenly, the narrative flips. The substantial revenue growth, a stunning 355% year-over-year to $146.1 million, is no longer just an abstract number, but a proven capability that has translated into securing a massive, multi-year contract with a hyperscaler. This $3 billion deal with Meta is the immediate, powerful catalyst driving the stock up today, completely overshadowing the headline loss. This is the ultimate expectation versus reality moment. Investors expected capital intensity and short-term losses. They got capital intensity plus a massive, confirmed, long-term revenue backlog from a tech titan. This immediate commercial validation is what is causing the extreme intraday volume and price spike you see right now, showing a trading volume already well over the 15 million share average, indicating a scramble from institutional players who are either underweight or completely out of the stock. Looking closer at the recent stock movement, the sheer momentum is undeniable. Over the past year, Nebius stock has appreciated by over 400%. From a 52-week low near $17.39 to its recent highs around $141.10. Even before today's news, the stock had been consolidating after a strong surge in the late summer, which itself was fueled by a $17 billion multi-year agreement with Microsoft. That's a massive, previously announced deal, and today's news of the Meta contract provides critical confirmation that the Microsoft deal wasn't a one-off. The price action today reflects that institutional sentiment is rapidly adjusting its internal models to account for this newly confirmed, massive, and predictable revenue stream. Many of these contracts in the AI infrastructure space are essentially capital as a service, where the provider, Nebius in this case, finances and manages the high-cost GPU clusters, chips often supplied by NVIDIA stock, and then leases the compute power to the customer. This requires significant upfront capital, which explains the large net loss from continuing operations in Q3, but the long-term, high-margin, sticky nature of these contracts is what funds the bullish thesis. When you're using platforms like SoFi Invest or considering setting up an intelligent portfolio for a long-term retirement goal, this kind of volatile growth stock might be outside the scope of the automated advice. But for active traders using an interactive broker's trading platform to leverage intraday volatility, this is exactly the kind of setup they look for. The news of the $3 billion Meta deal also came with an announcement that Nebius plans to put in place an at-the-market equity program for up to 25 million Class A shares. This is a crucial detail that often gets overlooked in the euphoria of a massive contract win. An ATM program allows a company to sell new shares directly into the open market over time, rather than doing one large disruptive secondary offering. While management noted they will remain, quote, dilution sensitive, the market is interpreting this as the company's plan to efficiently fund the massive capital required for the Microsoft and Meta deals, effectively using the contracts as collateral to justify raising new equity. In a traditional company, an ATM announcement of this size would be a significant headwind, but here the market is viewing it as the necessary evil for growth, or even a positive sign that management is positioning to meet explosive demand. It's an acceptable trade-off, dilution in exchange for validated multi-billion-dollar growth. If you are tracking the institutional activity, you will see a divergence here. Some are buying the contract news aggressively, while others might be more cautious about the potential dilution from the ATM program and the negative net income figures. It's an active tug-of-war on the order books today. To understand Nebius, you need to look past its recent corporate history. The company, formerly a part of Yandex NV, was spun off to focus exclusively on its non-Russian business segments, primarily AI infrastructure and cloud computing, which is why you see a confusing history of past financials that show huge revenue declines. That's the legacy business being shed. The core business now is building and operating full-stack infrastructure for the global AI industry, including large-scale GPU clusters, cloud platforms, and developer tools. They are a pure-play bet on the insatiable demand for high-performance compute power that fuels the current AI boom, competing not just with smaller players, but also indirectly with the cloud arms of giants like Amazon, Google, and Microsoft themselves, but often by serving those very hyperscalers or their largest customers. Their subsidiaries include Toloka AI, a data labeling and crowdsourcing service, TripleTen, a tech education platform, and Avride, which is focused on autonomous driving technology. This diversified yet focused model on AI-centric services gives them multiple ways to capture value from the same core infrastructure investment. The near-term future outlook for NBIS is now framed by this contract visibility and the execution risk associated with it. The market is projecting substantial annualized run rate revenue growth into 2026, which is what justifies that high PE multiple. The NVIDIA stock supply chain is critical here. Nebius's ability to execute on these enormous contracts hinges on their ability to consistently acquire, deploy, and operationalize the latest, most powerful GPUs. Any hiccup in the supply chain or a pricing cycle shift in GPU costs could immediately squeeze their margins and halt this positive momentum. The expectation is flawless execution, and the risk is that they fail to rapidly deploy the infrastructure to meet the demand promised in the contracts, or that the cost to acquire the necessary chips outweighs the revenue. Furthermore, the autonomous driving segment, Avride, while small now, presents an optionality that investors in Tesla stock or other EV and autonomy players will recognize. If Avride can successfully commercialize its technology, it provides another layer of growth that is currently not fully priced into the stock, and it's another area where the core cloud and AI infrastructure can be leveraged. For investors who use tools like Fidelity Trading Platform or the Fidelity mobile app to manage their portfolios, the volatility of NBIS may require a higher level of attention than they would give a typical broad market ETF. This is an active management stock. The critical catalyst for the next quarter is going to be the commentary surrounding the deployment schedule for the Meta deal and any updated CapEx guidance. as well as the initial usage rate of their newly launched platform, the NBIS Token Factory, which is aimed at open-source AI models and could tap into an entirely new segment of the developer ecosystem. The opportunity lies in Nebius establishing itself as the premier independent AI cloud provider, the specialized service that even the giants turn to for customized compute power. The risk, as noted, is the capital structure and the continuous need for fundraising, which the ATM program highlights. The overall macroeconomic pressures, especially interest rates and the cost of capital, also play a huge role, as their entire business model is based on highly leveraged capital expenditure. The core tension is between the guaranteed revenue from the multi-billion-dollar deals, the reality that has lifted the stock today, and the substantial upfront costs and potential dilution